Thanks for joining us today on The Close. I'm Marella Fernandez. Markets close in 30 minutes. Let's get to the stories we're following in the BNN Bloomberg newsroom. Shares of Canadian Natural Resources trading higher today. The country's largest oil and gas producer posted revenue that topped estimates in its latest quarter, as well as better than expected profit. CNQ had record production that offset weaker oil prices. The company raised its 2026 production forecast and also boosted its dividend. Shares of Maple Leaf Foods are getting a boost after that company reported higher fourth quarter profit that topped estimates. Revenue also came in higher than expected. It spun off its pork business, and that also helped. Maple Leaf says it expects continued revenue growth and further margin improvement this year. Linamar shares are rising after reporting fourth quarter profit of $110 million, reversing a loss from a year ago. The auto parts manufacturer also posted higher sales and says most of its products shipped to the U.S. remain tariff-free. Linamar also pointed to recent acquisitions, including the purchase of a German iron casting plant as part of its strategy to strengthen its portfolio. Home sales in the Greater Toronto Area declined in February as both buyers and sellers remained on the sidelines. The Toronto Regional Real Estate Board says over 3,000 homes were sold, down over 6% from a year ago. The average selling price is also down by about 7% to just over $1 million. The TSX Composite has dropped 409 points so far on the day. It is down 1.2% to 33,532. And in the U.S., another streak of red. The S&P down 56 points, 0.8%. The Dow Jones is down 1.8%. That's an 880-plus point drop. And the NASDAQ has 0.6% down, so it's a 134-point drop for the NASDAQ. Let's get to oil today, which has been jumping around with the conflict in Iran. It is up now 6.9%, almost 7% on the day. A gain of $5.19 for West Texas. It's at 79.87. The Canadian dollar has been gaining momentum, outperforming the U.S. and other G10 currencies with that conflict in the Middle East. Iran, of course, vowing now to escalate attacks in the Gulf. Let's go to Jay Bala, CEO, AIP Asset Management. Jay, thanks for joining us. Why do you think the Canadian dollar is a bit of a go-to right now?
Yeah, no, thanks for having me on. Right now I think there's, if you look at the world today, I think people are looking for a more stabilizing force. And if you look at Canada, Canada's got strength in oil and gas and resources and a stable financial sector. And so I think, based on that, I think you're going to see a bit more strength on a longer term basis in our stock market. And I think you're going to see more people looking to Canada as more of a safe harbor, right?
Are other currencies also a safer place to go? Are investors looking elsewhere?
Yeah, look, the U.S. dollar is always the go-to in terms of just sheer size and depth, and that's always, I think, the first preference to go to. But I think as, the world is becoming a more sort of destabilized place and the world is becoming, more with sort of tariff wars, I think probably people are looking to diversify those bets. And, I think it makes sense to hold some U.S. dollars as well as some Canadian.
There was a deep sell-off at the start of the week. Markets haven't really recovered, or the TSX hasn't, and another streak of red today. You say generally that the markets do well in a war. What are you looking at for comparison?
Yeah, no, I think the last time, the most similar case to this would be the Iraq war that we had, for a while. And if you look at that, you had the initial sell-off. But the reality is, what happens in a war, right? Like in a war, governments borrow lots of money, they hire lots of people, they build lots of military equipment, and then they fight a war. And all of that, results in better growth for the economy, right? Especially if you're kind of in the North American side of things. So on that basis, as much as morally a war may be horrible, economically a war is actually kind of positive, at least from a North American standpoint,
yeah.
Right?
A driver of the economy. Okay, we took a look at the price of West Texas a moment ago. It was just hovering under the $80 a barrel mark. We don't know how long the conflict in Iran will go on, but Do you think that the price of oil will factor into the Bank of Canada decision?
I do not. I mean, I know it impacts the general consumer, and obviously they have to keep an eye on it. But the reality is oil in and of itself is not part of core inflation. It's part of the broader inflation calculation. And most central banks really just focus on core inflation. How's core inflation coming along? And so, look, I mean, I know oil prices going up kind of hits the pocketbook of the consumer, but in reality, it doesn't really influence policy decisions as much as people think it does.
If this conflict carries on for more than a month or 6 weeks, do you see it as being a pressure on the market? You mentioned markets you normally do well, but there are other ways, of course, the Canadian economy could be affected.
Yeah, no, I mean, you're right about that. But, the reality is I think the markets go up either way. It's not either it's a short-term war, in which case you get a relief rally, or it becomes a longer-term war and people say, okay, well, we're stuck, right? At the end of the day, it's time for the government to step up and really invest into the military and spend more money. So, longer term, as we saw in the Iraq war, longer term, the stock market tends to do well.
Okay, so what markets do you like right now outside of North America?
Outside of North America, I mean, I would pick other safe harbors. Japan's probably a good place to go. They seem to have found, they seem to have had a landslide election. The new government seems to be very pro-business oriented. And, that's another sort of safe harbor, right? The yen's always been sort of a stable or a more stable sort of currency. Japan's been a relatively stable economy in the world. And I think a lot of people will probably start looking back at Japan.
Okay, outside of the war, you still remain bullish on Canada.
I do. I mean, just if you look at what drives our stock market, the vast majority of it is its energy, its resources, particularly gold, and its financial services, right? Like, I mean, that's the entirety or the vast majority of our index. And I think all of those sectors will do incredibly well over the next few quarters.
All right, Jay Bala, CEO, Senior Portfolio Manager, AIP Asset Management. Jay, thanks for joining us.
Thank you. Thanks for having me on.
Coming up, we'll take another look at oil prices, which are still surging as we have the war in Iran and in the Middle East continuing. We're back in just a moment. Oil prices are climbing as escalating tensions in Iran fuel renewed concerns about supply risk and the potential global fallout. Traders are closely watching the Strait of Hormuz, where even minor disruptions could significantly impact world energy flows. We spoke to Cole Smead about this. He is the CEO of Smead Capital Management.
It's a very odd dynamic that's going on between the interaction of the state of affairs in the Strait of Hormuz, or just call it the geopolitics that we're looking at on the map and in our administrations, versus what's going on in security markets. What security markets have done so far is faded the idea that this will be a longer conflict, longer being, say, anything more than a couple weeks, which is odd. So I think it presents a real tail risk to markets. To your point, I mean, we own Frontline, which is one of the oil tankers. It's the largest oil tanker publicly traded out there. That's ran by John Frederickson. And it's a business that, gets paid on a per day basis to be moving oil or keeping oil on water, et cetera. And you're seeing this big spike in the cash markets right now. At the same time, the question is how many boats want to go out and move. Who those boats are typically moving oil for is countries like India and China. And so as we hear the developments of, say, the United States providing naval and insurance backstopping to the markets that cover these tankers, you have to remember a captain's job is typically to ensure the safety of his crew or her crew and the boat. And that is the starting point for most seafaring adventures. And if you can't do that, the insurance is the second thought. Does the boat owner want the boat running? And is it cheap enough to ensure that process? And so I think what it's doing is it's taking the United States and putting them into the policy of protecting foreign countries' oil flows and ensuring foreign flag boats in order to keep the price of oil lower, but trying to have success in Iran and keeping oil prices lower are just paramountly adverse to each other. and therefore what's going to give.
And you don't think it's possible that they can keep the boats moving through there and also win the war against Iran that they started with them?
Yeah, I believe there's a savior, but I don't believe in fairy tales. Okay, and I say that because the idea has been that because the United States had its swift success in places like Venezuela, with obviously ties to oil, that we are this surgical tactician. We are a very powerful country, but we're running into what's referred to as the escalation trap. It's the same thing that was seen in Vietnam, that once you provide presence and you become to show force, that force in your mind continues to grow bigger and bigger and bigger. And the escalation trap, or some call the smart bomb trap, bombs and wars change the minds of the people on the ground. And that ultimately for regime change is what you need. You need the hearts and minds of people on the ground to change. And there's already discussion of putting special forces on the ground. So the escalation trap looks like it's following its curve. Really from a political or military perspective, this is fighting the arc of history for cleanliness. And so what we don't get is why investors think this is just going to be this cute little adorable conflict, and therefore are fading the securities that benefit from the near-term disruption of this, but really shows that the oil markets aren't nearly as, there's not the glut that was claimed, and these tensions show that this is a much more fragile system of over 100 million barrels moving the earth every day.
So how are you playing this then? What are you doing with it?
Sitting on our hands and waiting for people to give us better prices on many of the securities involved in this. So I mentioned we own Frontline. Frontline is collecting daily cash rates that have gone up. That being said, if you look at the supply, historically speaking, we did some rough math. There's about, even if you include dark fleets in that matter, there's about 16 years is the average duration of the boat that's out there floating legally or illegally. That's about a 6%, depreciation rate. And so if you said, well, what boats are being built in Asia today? It's roughly 3%. So we have this supply demand imbalance being provided to that market. So I think the real question is, how long does the tanker fleets really over-earn going forward? Because these risks, you get paid for risks in this life, and therefore we're going to see them over-earn for a season. So how much more added income we'll get from that? Other names would be, we own the Canadian E&Ps, we own Cenovus, we own Strathcona. Newer name to us would be like International Petroleum. This is a great torque market for those players, particularly like an International Petroleum or a Strathcona. And so the torque that will go from higher oil prices affecting free cash through the operating leverage of these fixed assets, we think is very attractive for investors. Now, mind you, look at global indices. To quote the Monty Python, "'tis merely a flesh wound from a sector perspective." So investors are heavily underweighted. The piper is playing a song, and they're going to have to pay the piper here soon if this goes on a lot longer than people expect.
Cole Smead is CEO of Smead Capital Management. As the price of oil rises, so do gas prices across Canada. CTV's Heather Wright takes a look at what drivers have been paying at the pumps.
Sticker shock at the pump, with prices soaring across the country overnight.
I expect inflation at 3.5% by the end of the year.
According to GasBuddy.com, drivers in BC and PEI are paying the most, an average of 161.9 cents a litre in BC and 154.2 cents a litre in PEI. Quebec is seeing prices around 152 per litre, Ontario averaging 136.6 a litre, while the lowest prices are in Manitoba, Saskatchewan, and Alberta.
The longer this conflict goes, the greater the likelihood the price will reach levels that are extraordinarily uncomfortable for most Canadians.
20% of all oil traded passes through the Strait of Hormuz in the Persian Gulf, which Iran controls. Tanker traffic has been disrupted while energy facilities throughout the region have been attacked. While gas prices across the West are rising, China is feeling the pain much more acutely as they import 70% of their energy from the Persian Gulf. And some believe the U.S.-led strikes in Iran may also be a way to target Beijing ahead of President Trump's visit there later this month.
The fact that gas prices for me are a little bit higher while my competitor simply doesn't have gas is maybe another consideration.
Despite being an energy-rich nation, experts say Canadians are unlikely to see any relief at the pumps, as efforts to scale up oil and gas production cannot be done overnight. It's something that doesn't sit well with Luka Mihalik.
They should have done something 10 years ago, not today. Today, what can you do?
There are concerns the conflict in the Middle East will have an impact similar to Russia's full-scale invasion of Ukraine 4 years ago, when the price of a barrel of oil jumped by 20%. There is more oil at play in this conflict, but analysts say it all depends on how long the war lasts. Heather Wright, CTV News, Toronto.
Coming up, women make up a sizable share of the workforce, but many still face a gap in earnings. We'll dive into that in a moment. International Women's Day is on Sunday, and we're seeing some noteworthy signs of progress in the wage gap. But my next guest says there's still a long way to go in reducing what's called the motherhood penalty. We were joined today by Catherine Judge, Executive Director, Senior Economist at CIBC.
We are seeing some encouraging signs in terms of women with young children increasing labor force participation and increasing their contribution to families' earnings shares. However, when you look at women with children versus women without children, there's still a sizable earnings gap. So we looked at long-run motherhood penalties, and that's essentially the gap from the time that the first child is 5 to 10 years old. And that gap in Canada is on average 34%. So women with children are earning 34% less on average during those years than women without children. And that is much higher than in countries that have very accommodative parental leave policies, places like Sweden, where you see the gap at around 20%.
And is it strictly because of that then? Or are we seeing more equity? Are we seeing, in those countries, do we see more men staying at home as well?
So there are a few factors at play. There is research that shows in Canada, when subsidized daycare was introduced in Quebec in the late 90s, the motherhood penalty was essentially cut in half. Now, if we look at daycare enrollment rates in Canada, all provinces still trail Quebec greatly. So we know that increasing childcare enrollment engages mothers in the labor force better and narrows the gap. And then there also is the issue of unpaid childcare and household work, where women tend to do more. So women that are aged 25 to 44 do about 2 hours per day more than men on those tasks, which of course cuts into time that could be doing paid work. And we find there's a prominent body of research that suggests women are willing to trade lower paying jobs for more amenities and more flexible hours at work. And that's also tied into the what's called the fatherhood premium, which is where men actually can benefit after a child is born by earning more because they choose to work more hours. So there are a lot of factors at play here.
Are we seeing more, as more women make more money and rise up the chain, are we seeing more men staying at home, and are they suffering a similar situation, or do you have those numbers even?
So you are certainly seeing more men contribute to the unpaid household childcare tasks that I was speaking about. If you look back a generation ago, the gap has closed, has essentially been cut in half. So that, in our view, is part of it. If you look at the earnings of men and women pre-children, they evolve essentially in the same way. And then there's an immediate drop in earnings for women, of course, that go on maternity leave. In the case where the woman has one child, the earnings penalty essentially goes away by the time the child is 10. But for women who have 2 or more children, the motherhood penalty is much more persistent and carries on much longer. So one factor, of course, would be equalizing those unpaid tasks, which would free up more time for women to pursue career development.
And you mentioned about the daycare. Are there other things that might make a difference, too, to close that gap?
Yeah, so one other thing we looked at is flexible work, which is defined essentially as industries where 35% of employees have adaptable hours. And we see that women's growth in employment is overwhelmingly concentrated in flexible industries. So that's another factor, of course, to consider. But I think the low-hanging fruit here is the continued expansion of subsidized daycare and getting those daycare enrollment rates up closer to what we see in Quebec so that we can lower these penalties in the rest of the country, because the fact is that we're just not utilizing the workforce to its fullest potential here.
And I mean, we saw that huge boom with work from home at the start of the pandemic. It's carried through. We're starting to see people come back to work. Has that had an influence as well, or is that essentially the flexible hours? Is that looked at as the flexible hours you mentioned?
So when you look at participation rate gaps, so for women with children under 6 versus women who don't have children under the age of 18, there's been a narrowing in that gap that started in 2019. There was a significant narrowing, so that does suggest that remote work and more flexibility was a contributing factor, although we don't have detailed data on that.
Okay, so and so we might actually see a dip again then, as more and more people have to go back to work, and it seems like the women are going to have to make a choice on if they want to go back to work or not, or stay home.
I think it's really about focusing on within couples on, sharing the childcare and unpaid tasks more equally. That's been shown to make a big difference, but there are a lot of factors at play here. But I think it's pretty nuanced in terms of each family's situation. We're still seeing, of course, the effects of subsidized daycare that has not fully been realized yet. And I think we will get positive impacts on women's participation as that continues to roll out.
And then overall, what's the gap between men and women? I mean, can you do it as a general? What is that at now?
So there is in Canada, the long run's earning gap in terms of the motherhood penalty is 34%. And then there's also the parental gap, and there's the gender wage gap, which of course persists. We have done prior research into the wage gap that shows essentially women aren't being increasingly represented in managerial roles. So it's really about breaking that glass ceiling to narrow the wage gap further, because if you look at prior years, progress on that really has slowed down.
Catherine Judge, Executive Director, Senior Economist, CIBC. A last look at the markets before the end of the trading day. They are down today. The TSX Composite down by almost a full percent. The S&P 500 down 0.6, and the Nasdaq a 0.3 drop at this point. The closing bell is coming up next on Bay Street and Wall Street. Here are the closing bells for the end of the trading day. At the NASDAQ, Texas ringing the bell. In New York, Congressional Medal of Honor Society ringing the closing bell. And at the TSX, Women in ETFs Canada to celebrate upcoming International Women's Day. You're watching The Close on BNN Bloomberg. I'm Morella Fernandez. Here's how we ended the day on Bay Street and Wall Street. It was a down day for the North American markets. U.S. stocks fell as the ongoing conflict in Iran continued to shake the confidence of investors and also fuel concerns about long-term supply and disruption to the supply chains. The TSX down almost a full percent. The S&P 500 down 0.6%. The Nasdaq down about 0.25%. Now, despite the pullback, some companies did post some gains. Maple Leaf Foods reporting a 7% upside today, a $5.24 gain per share. Maple Leaf Foods is here. 5.6% gain, $1.50 up, taking the share price to $28.31. They reported stronger than expected fourth quarter revenue and profits. Let's go to Savaria, Canadian accessibility equipment manufacturer, also delivering a record-breaking fourth quarter. That moves shares up 8.6%, giving a $2.09 boost to the share price there. Let's go to the U.S. Salesforce moving up 4.3%, Oracle gaining 1.6%, and Microsoft almost 1% up today. Let's get to major travel companies that have performed. Expedia gaining 13.2%, helped by fading concerns around AI-driven disruption, and apparently they have limited exposure to what's going on in the Middle East. Booking Holdings also a gainer today. Shares of major U.S. carriers, however, falling. United Airlines, Delta, and Southwest Airlines all down between 5 and close to 7%. The Strait of Hormuz remains effectively closed as the war in Iran continues now into a sixth day. The closure has rocked global energy markets as investors worry about how long it'll be before that waterway reopens. David Nelson joins us, Chief Strategist at Bell Point Asset Management. David, thanks for your time.
Thanks for having me.
Why have American markets, you think, held up better than sort of European and emerging markets?
Well, we're better situated than most of the rest of the world. We're relatively energy efficient here. We can supply our own needs here. But like you said at the top, 20% of the world's crude travels through the Strait of Hormuz. And while it's relatively benign for us, essentially for Europe and emerging markets, they're having an energy heart attack. A very big concern for them, hence their shares have fallen much further than ours. But even today, that contagion started to spread over to the United States. The hardest hit sectors today were deeply cyclical. In particular, you saw industrials down, probably have one of their worst performances in months. A lot of things in retail got hit hard. And interestingly, maybe the most popular trade out there, which is momentum, probably had one of its worst performances since Liberation Day. So a lot of upside down trading today.
Okay, and how much would you say is coming from the conflict in the Middle East?
I would say the bulk of it for this week. I think the narrative is completely shifted. And with each passing day that this drags on, the concerns gets a little bigger. And on the first day, it was nothing for the United States. We opened down hard, and we actually closed in the green. A little less so, but we never closed near the lows. And even today, we didn't close near the lows. Not the same, really, for much of the rest of the world. Fairly chaotic in Europe, and then the wild trading that we saw in Korea. But I would caution investors out there, don't chase what's necessarily working today, because when the hostilities cease, a lot of these trades will reverse very, very quickly and very, very hard.
Okay. I had a previous guest say war is actually good for the markets. And I guess he meant sort of once they go on for some time, not the initial week. Do you agree?
It's been that way in the past, for sure. And that's one of those sentiments that'll work right up until the time that I use it. But it was certainly that way through the last couple of conflicts that I've been through. We forget these very, very quickly. And investors, I think it's why the retail investor goes out and buys the dip and why they've been successful in doing it, because sometimes these things, they can drag on for a few weeks, but once they end quickly. And I don't think there's going to be a prolonged war. I don't think Iran has the ability to sustain a war very long. They're probably running out of munitions right now.
Okay, so let's talk about what you expect to see if there is a conflict that goes beyond the initial 4 to 6 weeks, as discussed by the administration in Washington. If it ends up being sort of a 3-month war, what are you expecting to see as the fallout on the markets?
Well, that's gonna change the equation a little bit. If it goes to 3 months, you're gonna have to see numbers come down. Certainly, GDP numbers will come down, but investors, rather analysts, and most of the wirehouses, they're gonna have to start taking down their numbers for a lot of companies. And I would imagine for the deeper, the more cyclical the company, the more likely those numbers are going to come down. It's also important to note that if energy stays at these elevated levels, energy touches every line item of the income statement. By definition, you have to bring the numbers down. It is inflationary. The most disturbing thing this week is that there was no safe haven trade. Treasuries did not support you. I would say that the balanced investor, the well-diversified investor, was down as much as the NASDAQ.
Okay, let's get to one of your stock picks that you like. CME is a derivatives exchange. Tell me a little bit more about it.
Well, we've seen AI go from one industry to the next, and even companies like American Express were hard hit. A few weeks ago, a logistics company, C.H. Robinson, was hit with the idea of AI disruption. I wanted a financial name that was disruption-proof, and that's CME Group. You know, their core product is price discovery and risk transfer. AI is not going to disrupt a liquidity network with 125 million open positions. You can't replace a liquidity pool with a large language model. So it begged the question for me, it's a relatively expensive financial name at 26 times earnings. Is that too much to pay to sleep at night? I don't think so.
Got it. All right. CME one to consider for people. Let's leave it there. Appreciate you joining us. David Nelson, Chief Strategist, Bell Point Asset Management. Thank you. Coming up, our conversation with Linda Hasenfratz, Executive Chair of the Board at Linamar. That company reported fourth quarter beat yesterday. We're back in a moment. Canadian manufacturing company Linamar delivered its fourth quarter earnings, reporting strong growth in its mobility business, but margins came in lighter than expected. Linda Hasenfratz, Executive Chair of the Board at Linamar, joined us today.
As well, we had really strong earnings growth for the mobility segment, which has a lot of launches going on that are all helping to grow our top line and our bottom line. So we're really happy with where things are going on the auto side, because after all, auto parts are quite different from autos. So whereas the vehicles have tariffs, auto parts, as long as you're USMCA compliant, have no tariffs.
And so you've not been affected directly very much by Trump's tariffs at this stage?
That's correct. Certainly not in the auto business. In the auto business, because everything we do that we ship to the U.S., we make within North America. So that's been a long-time strategy of Linamar, to not make parts in Asia or Europe and ship them to North America. We try and stay within the same continent that our customer is. So we make, parts in Europe for Europe, Asia for Asia, and North America for North America. So that means if you're, USMCA compliant, anything shipping from Canada or Mexico into the U.S. is tariff-free. So our industrial business has some impact. It's not zero, but it's a manageable level, and we're working to mitigate those costs further.
Just remind us of your auto parts / mobility business, revenue-wise. How much is in Europe, how much is in Asia, and how much is in North America?
Yeah, by far the largest percentage is in North America. I mean, if I look at, we have 86 plants around the world, 75 of them are in the mobility business. And of that, 22 are in Europe and just 6 in Asia. So obviously the lion's share of our mobility facilities are right here in North America.
And then you have your industrial business. We know it for Skyjack and those scissors. I think they're another type of lift. And then, of course, agricultural equipment. Can you give us a rough breakdown between your auto parts and your industrial? Which is the biggest revenue and profit supplier?
Yeah, so from a revenue perspective, the mobility business, which is auto parts, but also other types of vehicle on highway and off highway. So it is a blend there. It's not just sort of pass car, but that does represent 75% of our sales at the moment. So the other 25% is split between our Skyjack business, where we make scissor lifts, boom lifts, and telehandlers, and our agricultural business, where we make a whole series of different types of products for the crop cycle, from tillage to fertilization to seeding to harvest and post-harvest. So quite a big and growing business in the ag side.
What about the environment right there? I mean, farmers have been beset by low prices lately. Apparently a big swing will be, or a big determinant of their profits will be, when America gets around to announcing its level of price supports and incentives for the farm sector.
Yeah, the egg business is certainly in a down cycle. It has been for the last couple of years. So typically we're down in the egg markets, then you're kind of down more the next year, and then it starts to improve a little. So we are seeing this year, or expecting this year, to see that, little bit of improvement. When I say improvement, I mean it's not declining as much as it did last year. So the rate of decline is moderating. And we do see that happening through this year even. So starting out the year at a more negative place, and then by the end of the year, we're expecting the market to start moderating in terms of that decline. So that's a positive for the egg business. And in access, the market is predicted to be reasonably flat this year after a big down year in the market last year. Now, the good news is we've been growing market share in our agricultural business and in our access business, and that really helps to go a long way to offset these softer markets.
Just looking at your 5-year stock return here, total return of about 40%, including dividend. Bloomberg is showing a gain in the stock of about 30%. Our chart is showing 25%, but so not too far out. You certainly have outpaced Magna over the past 5 years.
Yeah, I mean, I think that when I look at our longer-term performance, Linamar has a great track record of consistent, sustainable performance. So it really drives out of this diversified model that we've created. We have our auto business, pass car, we've got commercial vehicle, we've got off-highway, we've got the ag, we've got access. And, they don't all sort of work on exactly the same cycles. So as a result, when things are a little soft on the auto side, often things are going well on the ag business and vice versa. So, as I just mentioned, things were a little soft on the industrial side last year, but at the same time, great growth on the auto side. So, in fact, if I look back over the last 16 years, we have grown our top line and our bottom line 81% of those years. 81% of the last 16 years, we've seen top and bottom line growth. And in the majority of those years, it was double-digit growth. Every year that we grew, but I think 2 or 3, we grew in double digits. So that consistent, sustainable growth, I think, is the basis for share price appreciation. I mean, we're delivering year after year after year, continuing to build market share, winning new business. We had a great year for new business wins last year. Our Canadian plants, as an example, had an outstanding year. They won more new business in our mobility business and our auto business than we have in the last 3 years. One last year in 2025. So we're pretty proud of that.
Linda Hasenfratz, Executive Chair of the Board at Linamar. Coming up, we'll speak with the CEO of AGT Foods to discuss their IPO earlier in the week. We're back in a moment. AGT Foods listed publicly this week, launching a $450 million IPO. That was Monday. It was the same day the TSX dropped like a stone. Murad Al-Khatib, CEO of AGT Foods, joined us now to talk about the IPO. Thanks for your time.
Thanks for having me.
So did you see this as just bad timing?
When you take a long-term view of a company and the listing process obviously is a decision we don't do for 1 day or 1 week of trading. You roll with the punches and you focus on the fundamentals of your company and deliver.
You mentioned that it is a process that takes a long time. Could you have held off if you wanted to?
You get to a point where you've got to make a decision, right? And the week before the listing was finalized, we hadn't had a war starting yet. So anyway, the decision was made, and again, no regrets. We wanted to take the company public again. Get back into the public markets. Fairfax and management founders decided that the time was right, and we're going to focus on executing free cash flow and growth. And protein and dietary fiber is a fundamental in the market, and we're very excited about the future.
You mentioned the conflict, which of course began on the weekend. Does it affect your business operations at all?
Well, we certainly have a very large business in the Middle East region. Of course, lentils, chickpeas, peas, beans are staple consumption items. And, we're very active actually with the United Nations agencies on the Gaza refugee program and other things. So, certainly, we're watching the conflict very carefully. But, unfortunately, for the world, we're going through this conflict, and, upon resolution, food is going to be a very important part of the resolution. So, again, our factory operations in Turkey are fully running with no effect. Obviously the Mediterranean region is sitting, in a very different position. So we're waiting for the resolution, and, our assets and our supply chain is going to be ready to be shipping what we believe is going to be large volumes of food needed to stabilize the region.
So are your shipments halted at a certain point right now? Have they been halted since the weekend?
Yeah, everyone in the world, it's not AGT specific, steamship lines and container ships are obviously, halting shipments around the world. We were very fortunate, actually, that we had a large volume of cargo that arrived into the United Arab Emirates just recently, just prior to the shipping line stopping. The balance of our cargo mostly is already at transshipment points, just more in Panama Canal or in Europe. So we have a very integrated supply chain, Marilla. We're going to be able to take that to other clients that are looking for cargo, and then we'll reship when the conflict is resolved. So
I was going to say, how long before this problem in the Middle East becomes more of a problem for your bottom line?
Again, we're diversified. We're shipping to 127 countries around the world. And, the Middle East is one, important region. But, this is pretty, in terms of stopping shipments, it's pretty localized into the Persian Gulf region. So, we do have notifications now that a number of the ports in Saudi Arabia are open. We have, ports even on the other edge of the United Arab Emirates, that are still open. Fujairah, for instance, is open. Jebel Ali is not. So, we don't, anticipate that, this conflict, number one, we hope it won't have the duration. But number two, we don't see a material effect on our business going forward.
You've got some workarounds. Okay, let's talk about 2025 revenue, which came in at $815 or $830 million. That's the estimate, I understand, down from over $1 billion in 2024. So what led to that drop?
Again, just we divested a business to get ready to go public. We actually sold a bulk handling business. We're really focusing on the packaged foods and ingredients, the better for you, gluten-free, high protein, high fiber, breakfast cereals, bakery and snacks markets, gluten-free pasta in the US, and pasta manufacturing around the world. And so when we divested some businesses and commodity prices came down, it leads to a lower revenue, but very consistent EBITDA. And, we see consistent growth going forward in both revenue, EBITDA, and free cash flow. So from that perspective, the business is really transformed from when we were public before. This is a packaged foods business now. When we were public, we were 18 million of EBITDA on the packaged foods. Today, we're 92 million and growing. And, that packaged foods business, the health and wellness trend is not a fad. Protein and dietary fiber are fundamental. Demographics are driving it. GLP-1 drugs are driving the need for dietary fiber and protein. And I call it the earthquake in the food industry. It's coming quick, and food companies have to react or they're going to be destructed by consumer demand. So from that perspective, lentils, chickpeas, peas, beans are important protein and fiber crops for the world.
Okay, so you took the company private only in 2019, so 7 years ago, and you went public again this week. What led to a decision to go back into the market?
Well, great partner in Fairfax. Fairfax owned 59.6% of the shares. They continue to own, call it 56% of our shares. So Prem Watsa has been an incredible partner. We did the $450 million public offering and a $200 million private placement of Fairfax on top. So, with the growth, EBITDA tripled almost in the period of 6 years on the privatization. Revenues doubled, EBITDA tripled, free cash flows growing. We wanted to get the balance sheet right. So, we've gotten down now, post-IPO, we're at 0.2 times approximately debt to EBITDA. That gives us a pristine balance sheet with high free cash flow conversion and growth platforms that are winning. And, again, the runways on dietary fiber, protein, and lentils, chickpeas, peas, beans, pasta is a long, long runway. So we believe that Canadian companies need to be public if they're strong and building a champion platform like we are. And we thought the time was right to do that.
Okay, so stock's at about 21 and a quarter. Your IPO was at 23. Clearly, you believe that, as you said, there's an earthquake kind of shift in the way people are eating. How are you going to restore confidence for shareholders?
Well, again, we're on day 4 of trading, and so we're going to take it again a quarter at a time, and we're going to deliver. And we were very clear in the IPO roadshow. We saw over 150 institutions around the world in a very involved marketing of the company. And, we believe strongly that, listen, free cash flow doesn't lie. And low leverage is going to lead us in a modular CapEx strategy where we can keep low CapEx intensity to growing our capacity in pasta and better for you packaged foods, that ultimately free cash flow conversion is really high with low leverage. The company's going to become very valuable. And that's what we're going to focus on. And, it's an unusual IPO. Fairfax sold no shares and subscribed to 200 million more shares. And me as the founder sold no shares. Usually it's the opposite. Sponsors selling at the peak, founders are trying to cash out. In our case, we rolled everything. We're going long term and we're going to deliver.
Murad, I got to leave it there, sir. Thanks very much for joining us on the close today. Murad Al-Khatib is CEO of AGT Foods. The Prime Minister addressed the Australian Parliament, talking about shared values and the strength of future collaboration between the countries. CTV's Abigail Beeman has more right now.
A warm welcome down under.
The distance between our two nations has never mattered less, and the closeness of our values has never mattered more.
In the Parliament of our shared Westminster system, Prime Minister Mark Carney highlighted many ways Australia and Canada are similar.
Two proud democracies, the true north and the land down under.
Carney spoke of coming to reaffirm the alliance as global architecture is breaking down in consecutive crises, and gave many nods to his well-received Davos speech.
Every agreement signed, every coalition deepened, every commitment made is variable geometry in practice.
And he announced Australia is signing on to the G7 Critical Minerals Alliance. Plus, there are new partnerships on AI and defense.
We're actively exploring new opportunities to protect our vast territories.
Canadian soldiers will begin training on the new radar Canada is buying from Australia later this year.
The world will always be driven by great powers, but it can also be shaped by middle powers that trust each other and act with speed and purpose.
After wrapping up his second Australian stop here in Canberra, Mark Carney heads to Tokyo for the final leg of his Indo-Pacific trip.
CTV's Abigail Beeman reporting there. Coming up next, NVIDIA shares wavered after the CEO stated that the company's recent $30 billion investment in OpenAI might be the last one. Back in a moment. Here are the stories we're following in the newsroom. Shares of Tourmaline Oil down today. The company achieved record production in its latest quarter, but posted profit and revenue that fell short of estimates. Tourmaline also announcing it sold its natural gas assets in northwestern Alberta for $765 million. They aren't saying who's buying it, but did say it is a senior Canadian producer. It plans to use the proceeds to reduce debt and build infrastructure in BC. Shares of Kinaxis up today. The supply chain management firm saw revenue surge 16% over last year and top estimates. Profit also came in above consensus. The company's full-year revenue outlook better than expected. Robust demand and record bookings also fueled the quarter. Shares of Canadian Natural Resources up today, the country's largest oil and gas producer, posted revenue that topped estimates as well as better than expected profit. Results helped by record production that actually offset weaker oil prices, output up by about 13%. And the company raised its 2026 production forecast. It also boosted its dividend. We have fourth quarter earnings coming in from Marvell Technology. Let's have a look at what happened there. Fourth quarter results, the adjusted earnings per share coming in at 80 cents versus 60 cents year over year. The estimate had been at 79 cents, so a beat just a little bit for the company there. Net revenue, $2.22 billion. That's up 22% year over year. The estimate had been just shy of that at $2.21 billion. Data center revenue at $1.65 billion. That's a 21% increase year over year. And the estimate had been just under that at 1.64. The CEO says their revenue growth was driven by robust AI demand. Next quarter forecast sees net revenue coming in between $2.3 billion to $2.5, and the estimate had been at that lower end at 2.3. Investors liking it. Stock is up over 9% in after hours. Let's go to Angelo Zeno, equity analyst and senior vice president at CFRA Research, to look at these numbers. Okay, so they beat, Angelo, but not in any major way, just slightly from what was estimated. What's the key metric for you for this company?
Yes, thanks for having me. So, I think the key metric continues to be that the data center revenue trajectory that the company has. I think, with Marvell, unlike some of the other compute-oriented names, and we typically look at four big ones, right? It's NVIDIA, AMD on the GPU side of things primarily, and then you get the more custom silicon-oriented business. You had Broadcom report last night, and Marvell's kind of a smaller version of Broadcom in many respects. But when you kind of think about that data center business, it's been a little bit more choppier than some of the other compute-type names here in recent memory. A big reason for that is they are very highly tethered to Amazon at this point in time. So we kind of want to see and hear on the call, what that data center trajectory looks like as we progress through the year and even into 2027, what kind of visibility they have on that side of things. Our view clearly is the fact that, hey, listen, some of the recent choppiness that they've seen probably alleviates, and you're actually going to see growth start to accelerate as new offerings come into the market here over the next couple of quarters.
I'm always amazed at when the tech companies report and who actually benefits from that in the share price and who doesn't, because a lot of them, as you know, getting hammered. In this case, Marvell is not. Do you see any reason behind that?
I think there was a lot more cautiousness around Marvell going into the print relative to some other names, and I'd say that's been the case for quite some time at this point in time. Interestingly, you had Matt Murphy, their CEO, just last quarter, essentially come out and say, "Hey, listen, business is extremely strong. We see no signs of potential hiccups here along the way." In terms of an air pocket. And, based on these results and the guidance that they provided, at least it looks like in the near term here, any type of, concerns or, wariness on the stock here looks to maybe have been a little bit premature. So it looks like, at least at this point in time, some of the fears and some of the multiple compression we've seen here over the last couple of weeks and months, again, maybe provided an opportunity here for some investors.
Okay, let's talk about NVIDIA for a moment. That stock been hammered today a little bit for a number of different reasons. But the CEO says NVIDIA's $30 billion investment in OpenAI might be the last time. How do you interpret that? What is the reasoning around it?
Yeah, I mean, when we think about it, I mean, clearly it is a bit of a step back from what they came about just back in September or so last year, and they've almost been kind of stepping back here over the last couple of weeks. I'm not necessarily surprised by it. I'm not necessarily concerned about it, but I will say this: the initial $100 billion commitment that was made by OpenAI to NVIDIA wasn't necessarily something I thought they were going to even fully complete. It looks like it's completely off the table at this point in time. That $30 billion, clearly I think is more along the lines of NVIDIA trying to support OpenAI, which is going to be a big player as we try to build this AI infrastructure environment out. So 30 billion of that 110 billion that OpenAI just announced in terms of the offering. And as we kind of look ahead, again, NVIDIA saying this might be the last because you are going to have that IPO. It's going to be a massive IPO. You're going to see some significant, additional funding here from OpenAI. And when you actually just look at some of the forecasts that OpenAI just put out a couple of weeks ago in terms of the revenue trajectory through the end of the decade, you're looking closer to 200 billion. The hope here clearly is over the next kind of 18 to 24 months, a lot of the the kind of the acceleration in terms of the revenue hopefully will be enough to at least largely self-fund the business.
Angelo, I got to leave it there. I'm already out of time with you, but appreciate your time on this. Angelo Zeno, CFRA Research, thank you. Coming up next, shares of semiconductor-related stocks traded mixed today. This was after Bloomberg reported that the U.S. government seeking to gatekeep AI chips. Back in a moment. Bloomberg reporting today the U.S. government wants to be the gatekeeper of AI chips. Washington looking at requiring chip shipments to be approved before being sent out. It would essentially give the U.S. government control of where things get built and who uses what. Let's go to Dan Ives on this, global head of tech research at Wedbush Securities. Dan, beyond the logistics nightmare that this would involve, what is your take on the idea of the U.S. controlling who gets what?
Look, I mean, part of it, there's a game of poker that's going on right now, where, especially in the arms race versus China, especially with NVIDIA relative to selling the H200s. Look at the logistical nightmare. And we got to see as this all plays out. I think it'll probably be simpler once it does play out. But look, the U.S. recognizes that, for the first time in 30 years, U.S. is ahead of China when it comes to tech relative to AI. But these companies don't want Big Brother.
Okay, could this backfire and force countries to use chips perhaps that aren't American, or force American companies to make those chips somewhere outside of the U.S.?
Oh, of course. I mean, could it backfire? Look, you want government to be involved to some extent, but you don't want them deep in the weeds. Because ultimately, look, this is about which technologies are the best, what enterprises want, and you don't want too much sort of interference from a government perspective. So, I get what Trump administration is doing. It makes sense relative to especially the China threat, but the devil's in the details as it all plays out.
Okay, do you think it's even feasible?
I think 30 to 40% of it's probably feasible. In terms of relative to some sort of control, some sort of sign off. I think realistically, the biggest area that they're going to be focused on is relative to China.
Got it. Okay, let's talk a little bit more about something that came up. Big tech pledging to help lower the energy costs for Americans. Of course, it's a midterm year, and that's of concern to Washington. They've joined a rate pledge. But with what they've signed on to do, which sounds very encompassing, it could cost them billions of dollars. Is that what it reads to you as?
Look, I think they almost need to. I mean, you can have big tech companies driving up prices 30, 40% for consumers when you have data centers. I mean, think about it, you have more data centers under construction today in the U.S. than active data centers. So I think it makes a ton of sense what they're doing. And also, the last thing you want to do is when a data center comes into a community, a town, it gets voted down because they're going to think that ultimately electricity prices go up so much for the average consumer.
Okay, so let's talk about which companies you can see taking this on. I mean, obviously, many of them have pledged to, but which ones do you think can handle this and still deliver reasonably to shareholders?
Yeah, they all, I mean, you're talking about about $1 trillion in the balance sheet combined. So look, from Microsoft to Google to OpenAI, obviously Oracle. I mean, everyone's going to have to participate in this. But it really comes down to the hyperscalers, as these cloud build-outs happen in terms of what that means relative to who's going to bear the cost from an energy perspective. And I think that's why you talk about before chips and the government, in terms of Trump administration getting involved, and that probably being less feasible or maybe, throws sand in the gears a little. Here, it makes sense that they're getting involved, especially given relative to, some of the concerns of U.S. consumers.
Okay, so they're getting involved, but this reads in a way that they have to build their own infrastructure in certain situations. So again, that is a huge commitment, and I guess the energy that they get from what they build will be their own.
Yes, and then that's also a double-edged sword because, okay, they pay for it, they have more energy, eventually there's energy shortages. Like, I think that's one of the broader concerns, is that the biggest constricting force in this whole thing, it's energy. Now, look, China's well ahead of U.S. in energy because of nuclear, but that's going to be the sort of balancing act that they're playing out as this, as we see this all over the next 6, 9, 12 months in this AI revolution.
Okay, so again, the question comes to mind about oversight, right? How are you going to oversee something like this? Does the federal level control the infrastructure and then the state level control part of it as far as production goes? I mean, do you see how this would work?
I think it's going to be much more federally controlled. I mean, I think there's a lot less comfort in the state because you can't have different states, different regulations, different structures. I think that's actually some of the worry. Look at China right now. They're all rowing in the same direction. So I think it needs to be something from a federal perspective. Look, but to monitor this, how this is all going to play out, I think that's some of the questions that people in the industry still have.
All right, Dan Ives, I could leave it there, sir. Dan is Global Head of Tech Research, Wedbush Securities. Thanks for your time. Up next, global supply chain company Kinaxis reporting fourth quarter earnings. We'll break it down in a moment. Kinaxis reported a fourth quarter beat on both revenue and profit. The global supply chain company announced major investments in their agentic AI architecture and Maestro platform. We got more from Razat Gaurav, CEO of Kinaxis.
It's really three things that are driving the growth and the momentum. It's firstly all the demand and supply volatility in the world, and our customers are trying to deal and grapple with this volatility. And they are trying to become more agile and adaptable. And, our Maestro platform is helping enable that. So that's the first thing. Second, I think we've really improved our own execution and go-to-market motion significantly in the last 12 to 18 months. And then thirdly, there's a whole replacement cycle happening in the world of supply chain planning and decision-making from old legacy systems to platforms that are really architected for moving forward in the world of AI and agentic infrastructure. So these three things are really what are driving our growth.
Now, and looking to your guidance for 2026, you're optimistic about it. But for the last month or so, SaaS and software stocks have taken a hit. Any concerns about that moving forward? The concern, obviously, that AI could be replacing them. How are you countering that?
Yeah, look, we've had a lot of discussions on that and had a lot of deep sort of thinking sessions on that topic. Our conclusion is that, while AI, particularly generative AI and agentic AI, will have a profound impact on our solution domain, and we're leaning into that, we are very confident of what we've built in Maestro, which is really in reflecting the complexities and the interconnectedness of the physical supply chain in our digital Maestro platform, and then adding the intelligence layer with all the mathematical modeling, which involve deep optimization, heuristics, advanced machine learning, to help our customers make very important and strategic and consequential decisions on inventory and forecasts and material availability and manufacturing and production. All of those things don't get replaced by agentic AI or generative AI. They only get supplemented by generative AI and agentic AI. And we are leaning into that in harnessing the power of generative AI to create a conversational interface, to use the reasoning models. And with agentic AI, we're really trying to really expand from planning into an orchestration platform, a composable orchestration platform. So it's really exciting for us. And in many ways, we look at the latest advent of AI being a tailwind for us. But I know the financial markets have had a different point of view for all enterprise software companies, and we're in the penalty box right now. Our approach is to keep hunkered down on the first principles and creating value and innovating for our customers and performing on a consistent basis. And hopefully at some point, the markets will realize that this is a tailwind for us and not a headwind.
And any concerns with competition, maybe a little more nimble, a little smaller, coming up on you with the way AI is allowing people to kind of do leaps and jumps at times? Any concerns that you might face a competitor that you didn't expect to see?
Yeah, look, we're always, on our toes, and it's always day one for us, right? If I can say so, and we don't ever want to get complacent about any situation. However, having said that, we have a strong degree of confidence in what we've architected and built, and what we've architected and built is not simple. We solve very hard problems for our customers. It requires depth of domain knowledge, and in reflecting the physics of the supply chain. You really need to understand how all of this connects to each other and have deep mathematical modeling, competencies. So someone who's just going to be vibe coding their way through it, they may be able to create more simplistic applications, but ours is a very complex domain, and we feel very confident in our ability to sustain our market leadership. Now, we're not standing still. We're investing, we're innovating, we're transforming as well, but we feel pretty confident in our competitive stance at this time.
Where's your investment focusing?
Really, it's in investing in our core platform, right? So both in terms of building out our core AI-driven planning capabilities, but also in building out an extensible and a composable agentic architecture where we are investing in an expanded data fabric, in a semantic layer, and then all the agentic infrastructure to create composable orchestration use cases. That's really where our bulk of our investments are going. In addition to that, we're also expanding our coverage model and our go-to-market reach as well. We had a fantastic Q4 in 2025. We announced our earnings and had our earnings call earlier today. And we want to continue that momentum because ultimately we have an incredible opportunity to grow both within our existing customers. We have over 400 customers, and also in net new logos, because there's about 14,000 companies we can be going after around the world. We want to attack that in a thoughtful, systematic way, but we're really investing in both in our platform as well as our go-to-market.
Okay, and you mentioned earlier about day one. It's not quite day one for you, but you've been there 2 months, I guess, now about. And but the news today, Blaine Fitzgerald is stepping down May 8th. What has it been like for you? And then moving forward, who are you looking for? Who do you find to replace him?
Yeah, look, the team at Kinaxis has been super welcoming. And as you can imagine, my first 30, 60 days, I've really been focused on listening, learning, assessing. I've also been talking up and down across the organization, but also engaging with our customers. I've talked to about 25 customers in the last several weeks, talked to several of our partners that are an important part of our ecosystem as we scale up the business. And I couldn't be any more excited than my first day on the job in our ability to build and scale the business. It's an incredible business. I feel really fortunate to be a part of that. Blaine, Blaine has been a fantastic partner. It's been really good to work with him last couple of months. He's pursuing his next phase in his career. And he's going to be with us through early May when we have our next earnings call. But, we're working very collaboratively. We've started an executive search for the CFO role. Really what I'm looking for is someone who's going to really have, the CFO background, have experience in working with publicly traded companies, particularly SaaS and tech companies, and someone who's going to be an important partner for me as we build and scale the business in the coming, several years. We've started the search now, and in the meantime, Blaine is very much involved in continuing to making sure there's no disruption to the business.
Razat Gaurav is CEO of Kinaxis. All right, the U.S. president spoke to reporters moments ago about Iran, saying the country has now reached out in hopes of working out a deal to end the war. Trump apparently answered to them, saying, "You're being a little late, and we want to fight now more than they do." Now, he did not specify who from the Iranian side had been in contact, of course, because the leader was killed on the weekend, the Ayatollah, and many other high-ranking officials have also been killed in that conflict. So it's not clear who would reach out on behalf of the Iranian side and who would be ready to lead. It's also unclear whether or not there was any serious efforts to broker a ceasefire, that early conversation, or whether there has been any plan forward on that. A quick look at the markets as we end the day. We have them all down. The TSX down almost a full percent. The S&P down 0.6%. And the NASDAQ down about 0.25% today as markets still respond to the conflict in the Middle East. Thanks for joining us today on The Close. We'll see you back here tomorrow.